History tells us if a recession were right around the corner, it is unlikely that the one-year ratio of diversified bonds, AGG, divided by the S&P 500 would look like this and be making a new 52-week low in mid-February 2024. And just as the S&P 500's chart was in risk-off mode in calendar year 2022 and righted itself in Q1 of 2023, if we look at the same ratio, the diversified basket of bonds relative to the S&P 500, AGG divided by SPY, and we put the 200-week moving average, the 30-week, the 40-week, and the 50-week on the chart, it aligns with the message covered in the opening of this week's video, the S&P 500. 2022, we switched to a risk-off look, where on a relative basis, bonds start to become more attractive relative to stocks. Q1 of 2023, the ratio goes back to a full-bore bearish look, very, very similar to the look that we had after the COVID low here in 2020 and in calendar year 2021 when the S&P 500 performed well. Similar concepts here. This is TLT, 20-plus year treasuries relative to the S&P 500, mid-February 2024. In recent months, we haven't had, and we still don't have, a risk-off or fearful look on this chart. To help us better understand that, let's look at the shift as investors' tolerance for risk began to shift from risk on to risk off in 2007. Same ratio, TLT divided by SPY, S&P 500 on the bottom of your screen. It's noteworthy. When the S&P started to stall in the summer of 2007, the ratio bottomed here. When the S&P 500 peaked in October of 2007, the ratio started to take off in a confident risk-off manner, and the S&P 500 went in the other direction in a risk-off manner. Moral of the story, this transition from point A to point B really doesn't look anything like February 15th, 2024.